3. All three major indexes dropped simultaneously as yields spiked. A classic stagflation warning signal. This just happened, and most investors don't realize what it means yet. Here's what's really going on, and what you should be thinking about right now. The Dow, the S&P 500, and the Nasdaq are all selling off hard at the same time. That's not a coincidence. That's a signal. Bond yields are surging. When yields spike like this, every equity valuation model on Wall Street gets repriced immediately. Inflation fears are back on the table. Persistent price pressure is forcing traders to reprice how long the Fed stays restrictive. Higher for longer isn't just a phrase anymore. It's becoming the base case. And markets are finally flinching. Growth stocks and tech names are getting hit hardest. Their valuations depend on cheap money. Cheap money is gone. If you're holding duration-sensitive equities right now, your portfolio is absorbing real damage. In real time. Here's the knife in the gut. When the 10-year yield climbs, the equity risk premium collapses. Stocks stop looking like the only game in town. But here's what nobody is saying about this yet. This isn't just a rate story. The simultaneous breakdown across all three indexes, Dow, S&P, Nasdaq, with yields spiking in tandem, is textbook stagflation territory. Slow growth, sticky inflation, no easy exit for the Fed. The last time this playbook ran, it took a decade to unwind. Most retail investors weren't in the market for it. Now they are, and they're not positioned for it. First consideration: duration risk. Long duration assets, think high multiple tech and growth stocks, face serious multiple compression when yields climb. Educational perspective: understand exactly how much duration exposure is sitting in your portfolio right now. Second consideration: rotation. Historically, value sectors like financials, energy, and industrials have shown relative resilience in rising rate environments. That rotation trade is worth studying closely. Third consideration: cash and short duration instruments. With yields elevated, short-term treasuries and money market funds are generating real returns for the first time in years. That's a competitive alternative to equity risk. And investors are noticing. The market just delivered a loud, clear warning shot across the bow. The stagflation setup is real. The yield pressure is real. The question is whether this is a temporary spike or the beginning of a longer repricing cycle. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor.